you're going to see a whole series of these actors get crushed to zero over the next few months. In the contagion of leverage being caught offside with the lack of liquidity. Voyager is not that big a deal. It's kind of irrelevant in terms of, this is a diversified shareholder base. It's not FDIC insured in any way, so it's not putting any stress on the government systems in any way. All the shareholders should consider themselves educated, no different than when you go to Las Vegas, put it all on black, and it's red, you lose. That's exactly what's happened here. But the great news about this and why this is so good for the market and how this helps the crypto market is it educates the business models that aren't going to work.
Embattled crypto broker Voyager Digital has finally thrown in the towel and filed for bankruptcy. According to reports, the crypto firm has filed for Chapter 11 bankruptcy protection, becoming yet another casualty in the ongoing carnage in the crypto market. The bankruptcy proceedings started in the United States Bankruptcy Court for the Southern District of New York on Tuesday, July 5, 2022. Court documents show that the firm has assets between $1 billion and $10 billion and liabilities in the same range. Voyager also said it has approximately $1.3 billion of cryptocurrency on its platform, as well as over $350 million in cash, which it holds on behalf of customers at New York's Metropolitan Commercial Bank. In a Wednesday tweet, Voyager CEO Stephen Alick confirmed the news of the bankruptcy and cited prolonged market volatility and Three Arrows Capital's default on a $650 million loan as reasons for the move. We strongly believe in the future of the industry, but the prolonged volatility in the crypto markets and the default of Three Arrows Capital require us to take this decisive action, the CEO tweet reads. In a recent interview, Canadian businessman and Shark Tank celebrity Kevin O'Leary reacts to the news of Voyager's bankruptcy, as well as the viral liquidity issue among cryptocurrency firms. The venture capitalist, who is also a strategic investor at WonderFi, warns crypto investors about leverage trading and the importance of understanding counterparty risks before getting involved in such deals. He also talks about stablecoin regulation and how it can aid faster and more convenient transactions around the world. Please watch, share, and like this video. We also love to hear from our viewers. So ensure you drop your comments and observations in the comment section below. Thanks, and enjoy.
This is nothing new in the story of leverage. And so in every cycle, what happens is various actors, companies, take on more and more aggressive positions using leverage to goose returns, which is age-old. It works. It definitely works. Now, what you're going to find in this situation is many crypto operators, particularly lending platforms, have never operated it with such volatility before. So they were in the slow growth from Bitcoin, almost a decade ago, from $800 all the way to $60,000. And all along the way, some of them became really aggressive in using leverage, which is the traditional hedge fund model. Now, what happens, and this happens in equities, it happens in bonds, it happens in real estate, it happens in crypto. Crypto's the Johnny-come-lately new asset class with a whole lot of newbies in it. Great news about this and why this is so good for the market and how this helps the crypto market is it educates the business models that aren't going to work. So it's like taking a big spatula from the sky and scraping all the crap out of the market. And it's going to happen very, very quickly. So anything that was built on, a business model that is not going to work or can't sustain volatility is going to be gone. And it's a good thing. It's a wonderful thing. It's going to leave the industry much stronger. Yes, we must mourn the investors that got wiped out to zero, but even they are better off in the sense that they've been educated. You own crypto without leverage, and you understand your counterparty risk. When I hold crypto, and I know it's very volatile, I have zero leverage in any of my positions because I know tomorrow morning I could wake up down 38% in any token, any coin, any project. And really, that's exactly what's happened. So, but if you put on leverage, you learn the very, very important lesson. You go to zero.
Own crypto without leverage and understand your counterparty risk. That is Kevin O'Leary's piece of advice to investors looking to avoid getting wrecked by the many unregulated crypto lenders and exchanges. The Shark Tank celebrity also warns that many other crypto firms are going to make similar moves as Three Arrows and Voyager, especially if the crypto market does not pick up soon. Though Bitcoin is now trading at $21,832, the leading cryptocurrency is still over 30% down within the last month and over 70% down from its all-time high. The overall crypto market cap is also less than $930 billion. Let's get back to Kevin O'Leary's interview as he talks about stablecoins and suitable regulation of the cryptocurrency space.
Well, let's talk about that specifically, because I think it's a great topic, and for several reasons. Reason number one is people think that crypto, the entire sector, is going to get regulated all at once. That's not going to happen. The most likely scenario, and this is a personal opinion, but one I've been working on in Washington, along with others, is that we would like to get policy on just stablecoins first, because stablecoins represent a very powerful and efficient payment system. And we think we can get bipartisan support between both parties supporting the American dollar as a default currency for a global payment system. It's not going to be the Chinese yuan, it's not going to be the Swiss franc, it's not going to be the euro, it's not going to be the British pound. And the reason it would fall and default to the US dollar would be that that is the currency used to denominate most commodities. And so the challenge you have right now, and why there's so much pressure to solve this, is it's very inefficient to transfer US dollars over to Geneva, then put it into Swiss francs, and then buy Swiss Nestle stock or whatever it is you want to do over there. It's really slow, very inefficient, very costly, not transparent, and not easy to audit. And so all of that problem goes away with a stablecoin. Now, the proposed policy that you'll find in granular form in both the Haggerty and Toomey bills, and I've met with both of them as many others have, this is very simple policy. What it looks as, it says, okay, for any stablecoin, an audit every 30 days. And any asset underlying, holding up the value of the coin or token, cannot have a duration of more than 12 months. Now, you've seen that policy before. It's called a money market fund, and you'll find it at Fidelity and Putnam and many other financial services entities that are FDIC insured. Circle, if it wished, that issues USDC, could become a bank. They could be FDIC insured if they wanted to, but they are sort of leading the pack with crypto in terms of payment systems under a stablecoin that has not broken a buck. So you've seen even Tether trades below $1, it's 0.999 right now. And so when you break a buck, you lose a lot of confidence. So what I'd like to see happen here is that we regulate stablecoins first because of their utilitarian value within the crypto universe, and that get done in this calendar year. And the reason that might happen is Toomey is retiring, and he is a driving force, as you know, on the Hill, and is really behind this momentum and this bill, and has lots of support from both sides of the aisle. So I think that's good. Now, obviously, what happened to Luna is an example of what not to do. So again, a sad situation, billions lost, but a great education to the market. Algorithm-based stablecoins, nah, I don't think we're going to do that again. I'd rather see something backed by US dollar or assets that are very liquid, that can have duration less than 12 months. So that makes sense to me. So at the end of the day, the bad ideas get, removed by the big spatula. And again, it's unfortunate for those investors that didn't think it through, but not all stable coins are alike, USDC being the leader currently. Now, having said that, if you go look at current yields across the spectrum of duration from 1 month to 12 months, it's only 50 basis points right now. So right now, USDC, while it hasn't broken $1, is not a great place to park cash because you can do 1.2% in commercial money market accounts in US dollars. So at any one time, you have to manage assets as you always had to. I think USDC, when things stabilize and there's more demand for it, will probably have rates 300 basis points higher than 1%, but you just don't know. And when you were putting out loans on USDC platform, it would have been best to ladder them from 1 month to 12, so you'd still be accruing 3 to 4%. But everybody's learning. That's my whole point. That was a long dissertation about what I think is going to happen in stable coins. But if you're going to be in a stable coin, it's only a personal opinion, USDC is the one that has not broken a buck recently.
Leverage trading is a very powerful tool that can vastly increase potential returns on trades even when starting out with a small initial investment. However, like every other thing in life, it does come with risks. The higher the leverage amount, the higher the risks. This is why market experts like Kevin OLeary and Michael Saylor caution investors against putting everything in such trades without considering the risks attached. What do you think about Voyager's bankruptcy and OLeary's interview? Please drop your comments below and hit the like button. You can also subscribe and turn on post notifications for more videos like this. Thanks for watching.